In the world of economics, 2022 was a year of significant turbulence for pension funds in the UK. This period of instability saw the value of these funds plummet dramatically, falling by nearly a quarter. A key catalyst for this financial whirlwind was Liz Truss's mini-budget, which sent shockwaves through the market. This fiscal event was followed by a staggering loss of approximately £425 billion in assets. We're talking about a hefty 24% decrease in the overall value of scheme assets. This downturn was not limited to a specific sector, but spread across the board, affecting gilts, corporate bonds, and property alike. The aftermath of the mini-budget was indeed a financial storm that left its mark on the landscape of the UK's pension funds. Indeed, the ripples of the mini-budget significantly affected the bond market, leading to major losses in gilts, corporate bonds, and property. The lowest point for asset values occurred in September, pointing towards the after-effects of Truss's fiscal event. In a bold move, the government announced unfunded tax cuts. This decision, however, was met with a less than favourable reaction in the bond market. The market's response was swift and unforgiving, causing gilt values to take a nosedive. Gilts, crucial to the financial landscape, are government bonds issued by the UK Treasury. When their value drops, the ramifications are far-reaching. Among those hit hardest were pension schemes employing liability-driven investment strategies. These LDI strategies heavily invest in long-term gilts. As gilt values plummeted, these pension schemes found themselves on shaky ground. The precarious situation was further exacerbated by the use of leverage by some funds to increase their exposure to gilts. The sharp fall in gilt values triggered large collateral calls. Collateral calls are a demand by a broker for an investor to deposit further cash or securities into their account to meet minimum margin requirements. This, in turn, forced fund managers into a corner, where they had no choice but to sell gilts. The selling of gilts put further downward pressure on their value, creating a vicious cycle that sent shockwaves through the market. This domino effect, set in motion by the government's announcement, cast a long shadow over the financial landscape. The turmoil it caused was so significant that it prompted the Bank of England to step in. The crisis was so severe that the Bank of England had to intervene to stabilise the market. Despite the decrease in value, pension funds saw an improvement in their overall funding level of around 15% during the year. It may seem counterintuitive, but the financial storm that swept through pension funds in 2022 also revealed a silver lining. Amidst the turmoil and shaken assets, there was a surprising development that offered a glimmer of hope to those affected. The key to understanding this lies in the relationship between the assets and liabilities of pension funds. Typically, assets are the investments that pension funds hold, while liabilities are the future payments they've promised to their members. In the tumultuous financial year of 2022, both these elements took a hit, but it was the liabilities that fell more drastically. You see, liabilities are calculated based on several factors, one of which is the interest rate of long-term government bonds, or gilts. When the value of these gilts dropped sharply following the government's fiscal event, the effect wasn't just limited to the assets. It also caused the estimated value of future liabilities to fall, and fall significantly. In fact, liabilities fell by approximately a third in 2022. This fall in liabilities, which exceeded the fall in assets, led to an overall improvement in the funding levels of pension funds. Now, what does this mean? Well, the funding level is a measure of a pension fund's financial health. It's the ratio of its assets to its liabilities. So, even though the value of assets fell, the sharper fall in liabilities meant that the ratio improved. In the midst of the storm, the pension funds found a ray of hope as their overall funding levels improved. While it's crucial not to downplay the significant losses suffered, it's equally important to recognise this unexpected benefit. After all, every cloud has a silver lining, and in this case it was an improved funding level amidst a financial storm. As we've seen, the world of economics is full of twists and turns, and even a mini-budget can send shockwaves through the market. The mini-budget of Liz Truss, for instance, led to a significant decrease in the value of pension funds' assets, with a drop of around a quarter in 2022. The turmoil in the bond market due to the government's announcement of unfunded tax cuts led to a steep fall in gilt values, impacting pension schemes that heavily invest in long-term gilts. Yet amidst the turmoil, there was a silver lining. Despite the decrease in asset value, the overall funding level of pension funds improved by around 15%. This was mainly due to the fall in liabilities outpacing that of the asset value, demonstrating the resilience and adaptability of these financial structures. To stay informed about such important economic events and their impacts, make sure to subscribe to our channel for more insightful content. Remember, knowledge is power in the world of economics.